Okay, this video will cover stock valuation, the introduction to stock valuation. We will slowly begin the dividend discount model, spend a fair amount of time in cash flow and the free cash flow model, and then we will have a quick look at valuation with comparables. Okay, what's the price today, P0? Of a stock expected to pay a dividend D1 at time 1, and at which time also we believe we will be able to sell the stock for a price P1. So the price P0 today of this stock is the present value of D1 plus P1. If the equity cost of capital is given by RE, the present value of D1 plus P1 is D1 plus P1 divided by 1 plus RE. And RE will refer to this value as the cost of equity capital. So the expected return shareholders demand to buy this stock. So we have a stock is a risky investment. A stock is a risky investment. When investors buy shares of a company, they expect a return which has to reach at least a given level. So if investing in government bonds return 4%, investing in stocks should return more than 4%. So for some companies, investors will accept a 9% return. For other companies which are more risky, investors will demand a 12% return. And for other companies that are even more risky, investors will demand 25% return. So given the cash flows expected from the stock of a company and according to the risk of these future cash flows, the price of a stock today is next dividend plus next price divided by 1 plus the return demanded by investors for stocks of these companies according to the risk of these companies. Very good. What is the total return on a stock investment? So from P0 is equal to D1 plus P1 over 1 plus the equity cost of capital. We will isolate the equity cost of capital and determine where this cost is coming from. Okay, so we obtain RE is D1 divided by P0 plus P1 minus P0 over P0. So this is the total return on a stock investment. So what is it equal to? So RE is total return in the stock investment, which is equity cost of capital, which is the return demanded by stock investors. Good. D1 over P0 is the dividend yield. Today we pay P0 for 1 share of this company. Next year it will pay a dividend of D1. So the return to the investor in terms of dividend is the dividend yield, which is the next dividend divided by the price paid for the stock today. And the rest of the return comes from the stock price appreciation, the capital gain yield. So the return obtained by a stock investor has 2 components: the dividend yield and the capital gain yield. Okay, company ABC is expected to pay a dividend of $2.70 1 year from now, at which time the stock price is expected to be $34.80. If the company's equity cost of capital is 2.8%, What should the current stock price of ABC be? Well, the present value of 2.70 plus 34.8, which is $33.25. Now, if we separate the total return obtained by the stock investor in terms of the dividend yield and the capital gain yield, what do we obtain? So the total return of this investment is 12.8%, the equity cost of capital. The company is expected to pay a dividend of $2.70, which provides the investor with a return of 2.70 divided by the price paid for the stock today, which gives a dividend yield of 8.12%. And the stock is expected to appreciate to 34.8%, which is a 4.68% increase from the initial price of $33.25. So the total return of 12.8% is the combination of a dividend yield of 8.12% plus a capital gain appreciation of 4.68%. So dividend yield 8.12, capital gain yield 4.68%. Consider a stock promising a dividend D1 at time 1, a dividend D2 at time 2, and with an expected price of P2 at time 2. What should the price of this stock be today if the appropriate discount rate is RE? Well, P0 is the first dividend discounted over 1 year, plus the second dividend plus the price at time 2 discounted over 2 years. If we rearrange this equation, so in fact, D2 plus P2 discounted over 1 year gives us the price at time 1. Okay, so since P1 is the discounted value of D2 plus P2 over 1 year, so we can rearrange the equation for P0 as P0 is the next dividend over discounted over 1 year, and then we rearrange D2 plus P2 as D2 plus P2 divided by 1 plus RE, which is equal to, which gives us D1 over 1 plus RE plus P1 over 1 plus RE, which is exactly the equation we used in the 1 period scenario. Consider a stock promising a dividend of D1 at time 1, a dividend of D2 at time 2, and a dividend of D3 at time 3, plus an expected price of P3 at time 3. What should be the price of this stock if the appropriate discount rate is RE? Well, the first dividend discounted over 1 year, plus the second dividend discounted over 2 years, plus D3 and P3 discounted over 3 years. P2 is equal to the dividend 1 year later plus the price expected 1 year after time 2 discounted over 1 year. So if we rearrange our 3-period equation by replacing D3 plus P3 over 1 plus RE by P2, well, this takes us back to the 2-period scenario. So the price of a stock is given by next dividend plus next price over 1 plus RE. If we expect to hold the stock for 2 years, well, it's equal to the next dividend plus the dividend at time 2 years from now, plus the expected price 2 years from now, divided by the 1 plus the discount rate to the power 2. So if we plan on keeping the stock for 3 years, well, the price of a stock is the sum of all next 3 dividends discounted over the appropriate number of periods. So dividend 1 discounted over 1 year, dividend 2 discounted over 2 years, dividend 3 discounted over 3 years, plus the expected price at time 3 discounted over 3 years. And so on. So P3 is D4 plus P4 discounted over 1 year. So the price at time 0 is the sum of the next 4 dividends discounted at the appropriate over the appropriate number of periods, plus the expected price at time 4 discounted over 4 periods. And so on. We can move up to 5 and so on, and we can keep moving. So the price of a stock is the discounted value of all the dividends the stock is expected to pay from now on. So into perpetuity, so forever. So a stock company is expected to last forever. There's no end to a stock company. There's no expiry date. It's not like a bond. It's not like a loan. So there's no expiry date. There's no expiry date to the stock of a company. So the price of the stock of a company is the present value of all its future dividends from time 1 to infinity. Next, we will see how to value a stock for which the dividends have a constant growth rate. But this is the end of this first video.